The news is no news as the ECB and Bank of England keep rates unchanged, with the ECB saying risks seem to be on the downside, but banks' resilience needs to be strengthened. Joining me to discuss all is Neil MacKinnon from VTB Capital. Neil, the Bank of England reiterated their pledge to keep its benchmark rate low until employment, currently at 7.6%, falls below 7%. A recent string of data suggests Britain may scale back bond sales after Osborne cited forecasts that the economy will grow 1.4% this year, up from a previous projection of 0.6%. Now, what can investors take from this? What does it really mean for the UK economy moving forward?
Well, certainly the upgrade to the UK's economic growth forecast that was featured in the Chancellor's autumn statement is not really a surprise. We've had a string of economic data for the UK economy that has indicated an improvement in activity and demand. Particularly, there's been an improvement in the housing market in terms of increases in mortgage approvals and increases in house prices. So there's no doubt that against that backdrop, you'd expect to see an improvement in the budget deficit, which is what's happening. Improved tax revenues all helps. And certainly it looks as though the UK's budget deficit is now on a downward trajectory. So that does imply reduced gilt issuance. I think the forecasts are uncontentious. I think they're a fair reflection of what's happening, and I think that the implications of the Bank of England's policy is that there is an economic recovery taking place. There's not much need for further quantitative easing. In fact, if anything, the Bank of England's Monetary Policy Committee should actually, I think, give more thought to how they might exit QE and how they might normalise monetary policy going forward.
Over to Europe, interest rates are to remain at present or lower levels for a prolonged period of time. Draghi says they are ready to consider all available instruments. But given the impending stress tests, what tools do the ECB really have at their disposal? And do you agree that the low rates are fully justified?
The ECB, are running out of options. They're not like the Fed, and while there is scope for a further minor reduction in the refinancing rate, I think the ECB will undoubtedly have to consider the provision of more liquidity. There does seem to be a liquidity squeeze as we go into year end. Whether the ECB could move to outright quantitative easing is very controversial. Is likely to meet with objections from the Bundesbank and the German Constitutional Court. There's been some talk of negative deposit rates, but that's been tried in Denmark, and what happened was that the banks passed on the cost of that to their customers in the form of higher borrowing costs. So what is ostensibly an expansionary monetary policy actually had a contractionary effect and drained liquidity from the banking system. So I'm not sure that negative deposit rates are actually a good idea.
The inflation projection has been revised downwards by 0.1 of a percentage point for 2014 and 2015. Draghi added the ECB sees inflation of 1.4% for 2013 and that risks seem to be broadly balanced. Now, this was the info people were waiting for, but is still a far cry away from the 2% target. How will markets react to this, do you think?
Well, I think that the downward revisions to inflation forecasts just highlight the deflationary price pressures facing the Eurozone generally. And the ECB is missing its targets on both fronts, both in terms of money supply growth and both in terms of inflation. And one of the biggest sources of deflation in the Eurozone is the rising German current account surplus, which now stands at 7% of GDP. And that largely reflects subdued levels of domestic demand in Germany. It has a deflationary impact on the rest of the Eurozone and the global economy. And I think the ECB has to be very careful here that if they fail to try and prevent deflation taking a grip, then you could end up with the sort of Japanese-style economy that we saw during the 1990s. So it's a real problem, and this is entirely a function of the policy settings, the fiscal austerity that is taking place. And of course, deflation only actually works to increase real interest rates and makes the debt situation and throughout most of the Eurozone much more difficult. Debt GDP goes up, and certainly this is a sort of a key problem, I think, and a key challenge for policymakers at the moment.
The euro-dollar took a hit during the conference, and since the US GDP was revised upwards and jobless claims hit a 12-week low ahead of tomorrow's NFP figures. Does any of this change your outlook for the euro-dollar, and what about against the British pound moving forward?
Well, I think the US non-farm payroll report is, it's one of the key reports of the month, but the November report has taken on a lot of importance because it will determine whether the markets feel that the probability of the Fed announcing a tapering of its monthly bond purchases at the 17th, 18th December FOMC meeting actually increases. I think that, but we know that the Fed's latest thinking is that they want to send a message that tapering does not mean tightening. They're likely to wrap up any tapering announcement with dovish forward guidance, which features a reduction in the unemployment rate threshold. And the Fed will be hoping that the markets would buy into that scenario. If not, then we'll just see more interest rate volatility, upward pressure on Treasury bond yields, and a firmer dollar. And technically, euro-dollar is facing resistance around about the sort of 136.45 level. As far as the pound is concerned, certainly the improving growth situation, the likelihood of the Bank of England having to exit its QE program has given the pound some strength against the dollar. But I think the sort of a 163, 165 trading range is probably the best for it. And against the backdrop of a firmer dollar, we might see a move into a sort of a 162 trading range in the near term.
Neil, thank you so much for your time today. It's great talking all this through with you. Well, viewers, Ben Jones will be back later with the US GDP figures reaction, so please do click back for that. But for now, goodbye.